Right now, a retired school teacher from outside Nashville is handing the IRS $14,000 every single year on money she already worked for, already earned, and is now supposed to be living on. Not because she did anything wrong, not because her accountant made a mistake, because nobody showed her that 3 specific accounts exist inside the U.S. tax code where her money grows completely outside what the IRS can touch. Not tax deferred, not tax reduced, gone from IRS reach permanently over a 2-0-year retirement. That $14,000 a year becomes $176,000 handed to the Internal Revenue Service that the law never required her to pay. Here's the distinction that matters before we go any further. Standard deductions and credits reduce your tax liability. The 3 accounts I'm about to show you remove entire categories of income from IRS reach altogether. That is not trimming a bill. That is eliminating it for specific dollars entirely. My name is Mason Parker. For over a decade, I have studied retirement benefits, senior tax programs, and the financial rules that cost retirees thousands of dollars every year because nobody explained what was already available to them. Today, I am walking you through all 3 accounts, the exact verified 2026 numbers, and the specific mistakes seniors make with each one that eliminate the benefit entirely without them ever knowing it happened. Before we get into it, subscribe right now and turn on the notification bell. Over the past year, this channel has covered the bank account rules, the IRMAA surcharge appeal, the Social Security earnings record correction, and the Medicare savings program that eliminates the Part B premium entirely. Every one of those videos put real money back in the accounts of seniors who watch them. The people who are subscribed here find out before the damage is done. Hit subscribe and let us get into all 3 accounts. Before we get into all 3, there are 2 things I want you to hold on to through this entire video. First, the numbers matter here more than most people realize, and most of what you will find online right now is still showing last year's figures. The Roth contribution limit changed for 2026. The HSA limit changed. The income thresholds changed. I am going to give you the verified current numbers for every account because the difference between last year and this year is real money. Second, one of these 3 accounts had a significant eligibility change on the 1st of January 2026. That opened it to millions of seniors who previously had no access to it at all. Most people have not heard about it yet. I am going to cover exactly what changed and whether it applies to you. Stay through all 3 because account 3 is the one most seniors never consider, and it is the one that closes the gap the other 2 cannot reach. The first account is the Roth IRA. You have heard the name. Most seniors have. Here's what most people are never told about how it actually functions and why the correct 2026 numbers matter more than most people covering this topic right now are telling you. The Roth IRA is governed under Internal Revenue Code Section 408A. Contributions go in with after-tax dollars. Growth inside the account is completely tax-free. Withdrawals in retirement are completely tax-free. The IRS has no claim on that money at distribution. Not a percentage, not a bracket, nothing. Roth withdrawals do not count as income for federal tax purposes. They do not push you into a higher tax bracket. And they do not count towards your provisional income, which is the formula that determines how much of your Social Security benefit is federally taxable. That last point is the one most people miss entirely, and it is where the real dollar value of a Roth becomes clear. The provisional income connection. The provisional income thresholds that determine Social Security taxation are $25,000 for single filers and $32,000 for married couples. These thresholds have not been updated since 1983. In over 40 years, Congress has never adjusted them for inflation, which means retirement income levels that were comfortable in the early 1980s now push ordinary seniors into Social Security taxation without anyone intending that outcome. Every dollar pulled from a traditional pre-tax IRA counts toward that provisional income calculation. Every dollar pulled from a Roth does not. That difference is not just the income tax avoided on the Roth withdrawal itself, it is also the reduction in Social Security taxation that keeping provisional income lower produces. For seniors near those thresholds, that can mean the difference between paying federal tax on 85% of their Social Security benefit and paying federal tax on none of it. One account, 2 separate tax savings happening at the same time. The correct 2026 contribution limits. Now the numbers, and I want to be specific here because what is circulating in most places right now reflects last year's figures, not this year's. If you are under 50, The 2026 Roth IRA contribution limit is $7,500. If you are 50 or older, the limit is $8,600. That $1,100 catch-up amount increased this year under the Secure 2 Act indexing. Any resource showing $7,000 or $8,000 is giving you the 2025 ceiling, not the current one. For income phase-out thresholds in 2026, single filers can make a full Roth contribution if their modified adjusted gross income is below $153,000. The ability to contribute phases out between $153,000 and $168,000 and disappears entirely above $168,000. For married couples filing jointly, the full contribution is available below $242,000, phases out between $242,000 and $252,000, and is gone above $252,000. If your income falls below those lower thresholds, the full $7,500 or $8,600 is available to you right now. The backdoor Roth, when income limits block you. If your income sits above those phase-out thresholds, one legal pathway remains. It is called the backdoor Roth conversion, and it is confirmed as available under current tax law as of 2026. Step 1. Contribute to a traditional IRA which carries no income limit. Step 2. Convert that traditional IRA balance to a Roth. The conversion itself is a taxable event in the year it occurs. That tax cost is real and must be weighed against the long-term benefit of tax-free growth and tax-free withdrawals going forward. Understanding this strategy requires one specific warning that most discussions skip entirely, and skipping it is what creates an unexpected tax bill. The pro rata rule warning. If you have existing pre-tax balances sitting in any traditional IRA, SEP IRA, or simple IRA, the IRS aggregates all of those balances when calculating the taxable portion of your conversion. This is called the pro rata rule. Here is what that means in practice. You have $90,000 in a pre-tax rollover IRA, and you contribute $7,500 to a non-deductible traditional IRA intending to convert it tax-free. The IRS does not treat that $7,500 as a clean after-tax amount. It calculates what percentage of your total IRA balance is after tax and applies that ratio to the conversion. Most of the conversion becomes taxable income. The fix is to roll existing pre-tax IRA balances into your current employer's 401k before executing the conversion if the plan accepts incoming rollovers. That separates the pre-tax money from the after-tax contribution and makes the backdoor conversion tax neutral. Anyone with existing pre-tax IRA balances needs to understand this rule before proceeding, not after the 1099 arrives in January. The 5-year rule. One more rule before we move to account 2. Roth IRA earnings are tax-free only after the account has been open for at least 5 years and you are 59 and a half or older. The 5-year rule applies to earnings, not to the contributions themselves. The actual dollars you put in can be withdrawn at any time without tax or penalty. If you are opening a Roth IRA for the first time today, the 5-year clock starts now. That is a reason to open the account even if you start with a modest contribution. The clock only begins running the day the account exists. If you are not sure whether your current withdrawal strategy is pushing your Social Security into taxable territory, or whether an IRMA surcharge is running on income that no longer reflects your situation, both the provisional income formula and the SSA 4-4 appeal process are covered step by step in the Senior Money Defense Playbook. The link is in the description below, or scan the QR code on your screen right now to get your copy directly. Account 2 is the one most financial discussions describe correctly, but most people use incorrectly. And the mistake in how you use it eliminates much of the benefit entirely without you ever realizing what you gave up. The health savings account is governed under Internal Revenue Code Section 223. To understand why it belongs in this conversation alongside the Roth IRA, you need to understand one specific thing about it that no other account in the entire U.S. tax code can match: the triple tax advantage. The HSA is the only account structure in the entire U.S. tax code with a simultaneous triple tax advantage. No other account does all three of the following at the same time. Advantage 1, contributions reduce your taxable income in the year you make them. Every dollar you put into an HSA lowers your adjusted gross income immediately. not eventually, the year you contribute it. Advantage 2. Growth inside the account is completely tax-free. Interest, dividends, and investment gains inside an HSA are never taxed while they remain in the account. Advantage 3. Withdrawals for qualified medical expenses are tax-free at any age. Doctor visits, prescriptions, dental work, vision care, hearing aids, long-term care insurance premiums, all of it can be paid from the HSA at zero federal tax cost, now or decades from now. After age 65, the HSA gains an additional feature. You can withdraw from it for any purpose, not just medical expenses. Non-medical withdrawals are taxed as ordinary income, exactly the same treatment as a traditional IRA. But the qualified medical expense withdrawals remain permanently tax-free. That makes the HSA function as a traditional IRA with a permanent tax-free bonus for medical costs. No other account structure offers that combination. The correct 2026 contribution limits. Now, the verified 2026 numbers, because these have changed from last year, and the updated figures matter for your planning. The 2026 HSA contribution limit for self-only coverage is $4,400, not $4,300, which was the 2025 limit. For family coverage, the 2026 limit is $8,750, not $8,550, which was 2025. If you are 55 or older and not yet enrolled in Medicare, you can add a $1,000 catch-up contribution on top of those amounts. Self-only coverage with the catch-up becomes $5,400. Family coverage with the catch-up becomes $9,750. To contribute to an HSA, your health plan must qualify as an HSA eligible plan. For employer-sponsored plans, the 2026 requirements are a minimum annual deductible of $1,700 for self-only coverage and $3,400 for family coverage, with an out-of-pocket maximum that does not exceed $8,500 for self-only or $17,000 for family. Those eligibility numbers matter because what qualifies for an HSA in 2026 is broader than it was in 2025. And that brings us to the change I mentioned at the beginning of this video, the new 2026 HSA eligibility change. As of the 1st of January 2026, Bronze Plan and Catastrophic Plan health insurance purchased through the ACA Marketplace now qualify as HSA eligible plans. Before 2026, HSA contributions required enrollment in a plan specifically labeled as a high deductible health plan. Many seniors who purchased Bronze or Catastrophic Marketplace coverage did not have access to an HSA because their plan was not technically classified as an HDHP, even though it carried high out-of-pocket costs. That restriction no longer applies. If you are currently enrolled in a Bronze or Catastrophic ACA Marketplace plan, you can open and contribute to an HSA under the 2026 rules. This expands HSA access to millions of people who previously had no path to this triple tax advantage. Check your current health plan documentation or call your plan's member services line and ask specifically whether your plan is HSA eligible under the 2026 rules. If you are on a Bronze or Catastrophic Marketplace plan, the answer is now yes. The receipt strategy most seniors get wrong. Now the mistake. The one that quietly eliminates most of the long-term value of this account for the seniors who do have access to it. Most people use the HSA like a checking account. A medical bill arrives, they pull from the HSA immediately, the money is gone, the bill is paid, and the account balance stays low. That is the least efficient way to use this structure. The correct strategy is to pay qualified medical expenses out of pocket if you can afford to, and let the HSA balance grow invested inside the account for years or decades. Here is the rule that makes this possible and that most people do not know. There is no deadline to reimburse yourself for a medical expense from your HSA. If you pay a $200 dental bill out of pocket today and keep the receipt, you can withdraw $200 from your HSA tax-free in 10 years, in 20 years, at any point in the future, and that withdrawal is still a qualified tax-free distribution. The IRS does not require reimbursement to happen in the same year as the expense. This means every receipt you keep is a future tax-free withdrawal waiting to happen. The HSA balance grows invested, the receipts accumulate, and whenever you need a tax-free withdrawal later in retirement, the documentation is already there to support it. Keep every medical expense receipt from the day your account opens. Date, provider, amount, purpose. Store them somewhere safe. That file is worth real money in retirement. The IRMA connection. There is one more dimension of the HSA that connects directly to a rule many seniors are already paying for without knowing it. The IRMAA surcharge on Medicare premiums activates when your modified adjusted gross income exceeds $106,000 as a single filer in 2026. HSA contributions reduce your adjusted gross income in the year you make them. For seniors approaching that threshold, strategic HSA contributions can keep income below the surcharge line and preserve the standard Part B premium rather than triggering the additional monthly surcharge amount. HSA withdrawals for qualified medical expenses also do not count toward the income calculation that sets your Medicare premium 2 years later. Paying medical costs from an HSA keeps that income number lower, which protects your future premium from the IRMAA calculation that will apply 2 years down the line. The Medicare contribution warning. One restriction that catches seniors who wait too long to act on this account. Once you enroll in Medicare, you can no longer make new contributions to an HSA. Existing HSA balances can still be used for qualified medical expenses tax-free. But the door to new contributions closes permanently at the moment of Medicare enrollment. If you are approaching 65 and weighing when to begin Medicare, this is one of the financial factors that belongs in that calculation. Every year before Medicare enrollment is a year the triple tax advantage is working and compounding. Every year of delay on Medicare is a year of HSA contributions you can still make. The account is most powerful when you have years to let it grow before drawing it down. Account 3 is the one most seniors never consider. And when I say most, I mean the assumption people carry about this account is exactly what keeps them from ever looking at it closely enough to understand what it actually does. So before I explain what it is, let me be precise about what it is not. This is not a basic term life insurance policy. Term life pays a death benefit and carries no cash component. That is not what we are talking about. This is specifically an overfunded permanent life insurance policy, typically a whole life or indexed universal life structure, designed so that premium payments significantly exceed the minimum required to maintain the death benefit. The design goal is not primarily the death benefit. The goal is the tax-advantaged accumulation of cash value inside the policy structure over time. The 3 structural advantages. Advantage 1. Cash value inside a properly structured permanent life insurance policy grows tax-deferred under Internal Revenue Code, Section 7702. The growth is sheltered from annual taxation while it remains inside the policy. Advantage 2. Policy loans taken against the cash value are not taxable income. They are not reportable to the IRS. They do not count toward provisional income. They do not affect your Social Security taxation threshold. They do not trigger the IRMAA surcharge. From a tax reporting standpoint, a loan against your policy's cash value does not appear on your return at all. Advantage 3. Under Internal Revenue Code, Section 101A, the death benefit passes to your named beneficiaries completely income tax-free. Now here is what the Roth IRA and the HSA cannot match. The Roth IRA has a contribution limit of $8,600 for people 50 and older in 2026. The HSA has a self-only limit of $5,400 with a catch-up. A properly structured life insurance policy has no IRS contribution ceiling. There is no income phase-out. The strategy is available regardless of what you earn, and there is no required minimum distribution. At age 73, when the IRS begins forcing taxable distributions from traditional retirement accounts, cash value inside a properly structured policy remains sheltered with no distribution requirement at all. Those 3 advantages taken together cover the gap the other 2 accounts cannot reach. But covering that gap requires the policy to be built correctly. Which brings us to the one risk most discussions of this strategy leave out entirely. The Modified Endowment Contract Warning. If premium payments into a permanent life insurance policy exceed certain limits defined under Internal Revenue Code Section 7702A, the policy becomes classified as a Modified Endowment Contract, or MEC. An MEC loses the loan advantage entirely. Withdrawals and loans from an MEC are taxed as ordinary income until all gains have been distributed. The tax-free access to cash value that makes this strategy valuable disappears the moment the policy crosses into MEC territory. Any policy positioned as a tax advantage accumulation vehicle must be structured specifically to stay below the MEC threshold. This is not a standard insurance purchase. It requires working with someone who understands the technical design parameters, not simply buying a whole life policy and overfunding it without verification. The strategy is fully legitimate when built correctly. It requires careful setup and ongoing monitoring to preserve the advantages that make it worth using. That structure, when built correctly, is what makes Account 3 the piece that completes the picture. And the picture only makes sense when you see all three accounts working in the same direction at the same time, how all three work together. Let me bring all three together the way they actually function in combination, because that is where the real dollar difference emerges. Patricia's drawing $40,000 per year from pre-tax retirement accounts. At a 22% federal tax rate, that is $8,800 per year in direct federal tax on that income alone. On top of that, those pre-tax withdrawals count toward her provisional income calculation and push a portion of her Social Security benefit into taxable territory as well. Now run the same $40,000 through the three accounts. A portion comes from the Roth IRA. Those withdrawals are tax-free and do not count toward provisional income. Social Security taxation drops. A portion comes from the HSA using accumulated receipts from years of documented medical expenses. Those withdrawals are also tax-free and do not affect her income calculations. The remaining income comes from policy loans against cash value life insurance. Those loans do not appear on her tax return at all. They do not count toward any income threshold. The tax bill does not shrink. It disappears on the dollars moving through those three structures, and the $176,000 Patricia would have handed the IRS over 20 years stays in her account instead. The law did not hide these accounts. They are in the tax code right now. Patricia just was not shown they existed. Let me bring everything into one clear action plan. 5 steps, all of them available to you right now, and all of them connected to accounts that are already in the tax code waiting to be used. Step 1. Check your Roth IRA eligibility against the correct 2026 thresholds. Single filer. Full contribution available if your modified adjusted gross income is below $153,000. Partial contribution between $153,000 and $168,000. No direct contribution above $168,000. Married filing jointly. Full contribution below $242,000. Partial between $242,000 and $252,000. Nothing above $252,000. If you are below those lower thresholds, you can contribute up to $7,500 this year. If you are under 50 or $8,600 if you are 50 or older. If you are above the upper thresholds, look into the backdoor Roth conversion through IRS publication 590A. Before you execute it, check whether you have existing pre-tax IRA balances that would trigger the pro rata rule. If you do, investigate rolling them into a current employer 401k first. Step 2. Confirm whether your current health plan qualifies for an HSA in 2026. If you are on a bronze or catastrophic ACA marketplace plan, the answer is yes, starting the 1st of January 2026 under the new rules. Call your plan and confirm. If you are on an employer-sponsored plan, verify it meets the 2026 HDHP minimums of a $1,700 individual deductible and $8,500 out-of-pocket maximum. If you qualify and are not yet enrolled in Medicare, contribute the 2026 maximum $4,400 for self only, $8,750 for family, plus $1,000 catch-up if you are 55 or older, and start keeping every medical expense receipt from the day the account opens. Step 3. Identify your pre-tax retirement account exposure. Pull every account statement you have and identify which accounts are traditional pre-tax retirement accounts. Those are the accounts generating taxable income at every withdrawal and feeding into your provisional income and IRMAA calculations. Calculate your total pre-tax balance and estimate what your required minimum distributions will look like starting at age 73. That number is the gap the three accounts exist to close. Step 4. Calculate your threshold position. Write down 2 numbers: $25,000 for provisional income as a single filer, $32,000 if married, and $106,000 for the first IRMA tier as a single filer, $212,000 if married. Calculate where your current withdrawal plan positions you relative to both. That is your baseline. Every dollar moved through the Roth, the HSA, or the life insurance structure is a dollar that stops counting against those thresholds. Step 5. If your pre-tax balance is above $300,000, schedule a professional consultation. A fee-only financial planner or enrolled agent who specializes in retirement distribution strategy can show you the specific conversion and withdrawal sequencing that reduces the most tax across your retirement timeline. Life insurance as a tax strategy in particular requires proper policy structure to avoid MEC classification. That design conversation is not something to skip. I want to close by saying something directly to the seniors watching this who recognize their own situation somewhere in these 3 accounts. The Roth IRA, the health savings account, and the cash value life insurance structure are all fully legal. They are all sitting in the tax code right now. The question Patricia faced was not whether the law allowed them. She just was not shown they existed. The gap between what the IRS is legally entitled to collect from you and what it is actually collecting from you right now may be significant. Not because you did anything wrong, because nobody sat you down and showed you the structure. These 3 accounts are part of that structure, but they are not the complete picture. There are 6 other rules affecting senior income in 2026 that most people never find out about until after the damage is done. The bank account that legally transfers your savings to a creditor the moment your child's name goes on it. The provisional income formula that determines whether your Social Security is even taxable. The W-4V withholding rate that sends your own money to the IRS 12 months early. The IRMAA surcharge running on income you stopped earning 2 years ago. The joint account that bypasses your will entirely. And the Medicare savings program that eliminates the Part B premium for millions of seniors who have never applied. I put all of it into the Senior Money Defense Playbook. 9 rules total. Every government form named. Every phone number listed. Every action step written out in plain English so you know exactly what to do and exactly what order to do it in. If even one chapter puts 1 month of a missed correction back in your account, the guide has paid for itself many times over. The link is in the description below this video, or scan the QR code on your screen right now to get your copy directly. It is called the Senior Money Defense Playbook. Subscribe and turn on the notification bell. Share this with one senior you know who has never heard of any of these 3 accounts. The law did not hide this from them. Nobody showed it to them. One share from you fixes that. I will see you in the next one.